Well, officially, I'd like to go ahead and welcome everybody and say good morning and good afternoon to all of you around the world. I see we've got more than a couple of people joining us from overseas in Europe and then in Asia. So, thank you very much. For anybody, Todd, I can hear your microphone actually open. If you can probably mute that for a few minutes, that'd be great. And if we do, for some reason, go ahead and turn on somebody's microphone, if we just make sure that they don't have any extra background noise, preferably if they're on a headset. If we do, for some reason, put somebody on a microphone, that'd be great. And the other thing I'd like to go ahead and do is, say we kind of got a little bit of a structure and a format in the first part here based on all the questions you had asked us to make sure we get out there. And then we're going to have an additional follow-up open and answer, open Q&A section where you have new questions or important questions that you'd like to get answered out of today's session. So with that said, I'm going to go ahead and just go through a couple things on some PowerPoints real quick, and then we'll go ahead and move into the open Q&A. The first thing I like to do is go ahead and remind everybody, as I do in all of these webinars, it's very important. I take it very seriously. As you know, there's not a bunch of hype and fluff on my websites about making millions of dollars. Some of you have been doing very well and learning quite a bit and going ahead and stopped losing money. Some of you have turned profitable. Some of you are making more money than you were. Individuals' results obviously are going to vary. You need to go ahead and make sure you talk to a financial representative before you do trading of any sort, whether it's equities, futures, options, currencies, etc. It is very risky, and I don't think some people highlight that enough. I certainly do highlight it, and you notice I keep the hype off my websites and that. Because it is so uniquely individual. I've taught a lot of people over time, and it's amazing to see people do very well and other people do very poorly with the concepts you just got done teaching them. So you want to make sure, that's why I try to sometimes give those very thorough answers that Todd was alluding to earlier, because I try to make sure you guys understand things as much as possible. But understand, regardless, it is risky, and you should always consult a financial representative when you're dealing with your monies. Also, as you know, I've gone ahead and made each one of these webinars available to you guys afterwards for absolutely free to heighten your learning experience. I think that's very important, since I'm really trying to teach you here, not just give you an introductory webinar or introductory concept to make you have to come, keep coming back for class number 3, 4, 5, and 6. Each of the concepts you learned here, I want you to really learn. So I've given you the videos. The only thing I ask that you do, please, is keep them to yourselves and not share them out there on the internet and so on and so forth. So appreciate you doing that for me. Today we're going to kind of review the initial questions that you selected that Todd opened up with, and then we're going to go ahead and move into more of an open Q&A for those additional burning questions that you have. We're probably going to have to take a few more pauses than usual. As you know, the last 2 webinars, I think we've taken one quick pause in the 3.5 hour sessions that we did. But unfortunately, with my voice as it is, I may have to take a couple more today. So, but needless to say, obviously, we're going to be spending a lot of time together regardless. So, looking forward to that. Again, if you have burning questions, make sure you get those out to Todd. And Todd will be the primary person answering questions. Fletch will be there as well. But, I just want to make sure we get those questions answered for you today. And as always, this isn't a contest. This isn't I'm right, you're wrong. You're asking for my opinions on how I do things or my thought processes. And so, I'm here to share that with you. So with that said, what I'm going to do is turn this over to my charts, and give me just a moment, everybody. Okay. Everybody should go ahead and be seeing my charts. I just want to have that up there because at this point, I'm only going to be looking at my chart screen and focusing on the questions that Todd gives me based on your feedback. So with that said, Todd, let you unmute there and start asking questions.
Okay. Well, again, welcome everyone. So what we're going to do is, to reiterate, we're going to start with the indicators, moving average, support levels, Fibonacci, those types of things first. And we do have about maybe 10 of those 21 questions that people want to the answer. So I think that's a fair number, and that's actually good. So we can probably flow right through these and then get to the open forum for this section, and take a little break for Robert to learn Russ's voice, and then we'll come back and then start up with the setups, entries, exits, and continue on that way. So Robert, our first question is the second one here. It's or actually the first one was how to know. Excuse me. Again, these questions were taken right off email, so the English might not be proper because we all type really fast. But how do you know how many weekly levels we can realistically expect to attain if we do not, or excuse me, if we do have a breakout on each particular day? So let me read that one more time. How do you know how many weekly levels we can realistically expect to attain if we do have a breakout on each particular day?
How many of the weekly levels, and I assume what they're referring to is and if the person's in the room, they can perhaps add clarification to that question. What we're looking at is how far could the market move based on the different levels that are at hand. And what I would do is, let me point to the various pivot points, because this will help be a guide. The thing is that, if you remember the pivot points here, and as you recall, the blue ones are my daily pivots. The majority of the time, most days, so this is my primary pivot, this is resistance level 1, and this is resistance level 2. This is support level 1, support level 2. You know, these blue pivots are all on a daily basis. If you recall, the majority of the time, the market stays within the resistance level 2 band. In fact, here we'll go ahead and we'll look. Let's just do that real quick if we may. This is the primary pivot from yesterday. With all that movement that we saw yesterday, we didn't even actually get to resistance level 1 yesterday. However, on Thursday, look where we got. We got precisely to resistance level 2. Okay? So how will we know how far we can realistically move on any given day? Usually the market will stay within resistance level 2 on each daily move. Very seldom in fact, there are resistance level 3s out there. It's just that on the daily basis, the markets don't often move to resistance level 3. So when you're looking to set your targets, so your profit targets, you'll certainly be looking to exit the majority of your position if you're looking from a probability standpoint by resistance level 2. Todd?
Support, resistance, and moving averages, which is fine. The question I have is wondering why patterns do not play much of a role, such as flags, head and shoulders, and many more. If one has to take a look at the monthly SPY, you would see a bear flag this month, which play out to a T. Anyways, great site, Robert. So basically, he wants to know, why you don't particularly use pattern trading versus your MAs and support levels.
Well, I do go ahead and talk about, here on the multi-year chart, this is I've talked about in multiple videos, this is really a multi-year double top, pattern in the S&P monthly index. So, I do use patterns. I've focused on the fact. In fact, ironically, I've referenced many times the Edwards and McGee book, which talks about many of these classic patterns, and I've said that these patterns still work over time. The work that I do goes ahead and usually encompasses, those patterns. For instance, a W pattern or a double top or a triple top or a head and shoulders. Usually, as that pattern is forming out, it's breaking one of my key support or resistance levels. So I don't focus so much on the patterns. I do focus, if you notice, on congestion patterns, and it's just what my focus is. I will say this though, those patterns hold a lot of validity, you know, on a daily trade. For instance, one thing you do hear me talk about quite a bit is the divergences. And the divergences usually go ahead and are part of a formation, whether like a mini head and shoulders type pattern on an intraday basis. You know, as many times what they are, because you'll have a situation like here, you have a left shoulder, the market comes down, makes a lower low, and you really don't have the market moving as low as you did here. Let me get my highlighter on. Okay, Robert, you have to remind me there. Left shoulder, your head, and then your right shoulder. So you get this little mini patterns. But on an intraday basis, they're not as easy to spot as they are, let's say, on a daily basis or a longer term basis. I have gone ahead and several times pointed out bear flags. I've pointed out pennants in past YouTube videos. On an intraday basis in the channel, I do not point those out. But on my YouTube videos, I have actually gone ahead and a number of times pointed out those types of patterns. You'll recall also I do focus on, let me get my little drawing tool out, where we've gone ahead and had the coiled spring. How many times have you guys seen the coiled spring? Well, what is that? It's a consolidation pattern like we're being asked about. So I do talk about them. I may not call them, bear flags or, bull flags or so on and so forth sometimes, but I do speak to the actual patterns themselves and the consolidations and so on and so forth. So, but it's just a personal preference, the way I present my material, so I guess that is what it is. Nonetheless, those indicators or those flags, those setups are no less important for it. And I would remind everybody, on my website under Robert's Favorites, there's a book by Edwards and McGee, Technical Analysis of Stock Markets, and that. I think that's a fantastic book talking about a lot of those exact patterns going back to the early 1900s, and I've talked about how valid those patterns are. So I in no way, shape, or form discount those patterns. I think they're very valid. Todd?
Okay, great. I do have one question to add to that, because I remember getting this in the chat room this week, funny enough, is, with the patterns on the price action, that's one thing. What about patterns on the indicators like MA and in particular RSI with, the fishhook setups? Do you pay as much attention to those versus the price action?
Excuse me. Yes. You recall from last week's webinar, actually, let me get the tool off here. Let's go back to the concept of the fish hook. I've gone ahead and actually said that I kind of like looking at both of the price actions. Let me convert this to a line tool. If I can get the fish hook to show up or the broken bent finger pattern to show up, either one of those two patterns, on both the indicator, or the price action itself, as well as the RSI, that strengthens my conviction for the move. So I did go and indicate that in last week's webinar. I do like to see it. What I look for warning signs is where one of them, in fact, here's actually this one worked out okay. What I'm looking for is where one of them is more extreme than the other. Here's a case in point. It worked, but nonetheless, I don't like it as much. This RSI pattern here. This one looks nice. It's about a 45-degree angle, okay, where it comes down and goes back up. This here comes down and goes up a little bit higher than I would really like, almost to the 50% of the previous move here from, let me get a tighter tool in here to mark this with. From here down to here, it retraced back up about 50%. That's where it starts getting risky, and anything over 50%, I don't want to trade. So when we're looking at the fish hook coming down, I like it to be, that nice 45-degree angle and make more of a check mark, the broken arrow, the fish hook that I call it. I don't like it to go ahead and be at a steep angle and up here above this 50% level. Okay, those are some of the rules I look for when with the fishhook. Same thing is then with as it relates to the RSI. I like this. I like the same thing to happen with the RSI. I like a nice rise, a shallow pullback, and I'd like then the price action to be a rise and a shallow pullback as well. Okay. Todd, does that answer your question? So I do look for that, and I did mention in last week's webinar, I do use the indicator, in this case the RSI, as part of that confirming tool if possible.
Great, yeah. I just want to throw that out there since I know a couple of people asked me that in the chat room this week.
Okay.
Next question is, I need clarification on the 20-period moving average. Let's say price is pulling back to the MA on a 5-minute chart, but at the same time, it is a long ways away from price on the 15-minute chart. Which do I take?
Well, I tried to make my preference really clear on this over time that I prefer to trade off of the 15-minute charts. I know there's a lot of people that like trading off their 1-minute charts. There's a lot of people that like trading off their 5-minute charts. But from my perspective, I found that a lot of the analysis that I use, and a couple of people that have switched to that time frame have indicated the same thing, which is that the 15-minute chart seems to work best because to the point that the viewer made is that if you take the trade on the 5-minute chart, but you because it's at the 20 period on the 5-minute, but it's way away on the 15-minute, it's more likely to potentially fall against you and fall more down towards that 15-minute chart. My personal preference, my experience has been the 15-minute chart is more ideal. What I would say is if you're going to use a 5-minute chart, look at some of the other moving averages then too, like a 50 period and a 200 period moving average. Put those on there and see if you can get those levels to agree and tie into a level on the 15-minute chart so that you're getting some sort of confluence of circumstances versus just your 5-minute charts giving a signal. Because if just your 5-minute charts give a signal, unless you're going for a very short-term trade, you suffer the strong possibility of having it move more than a point or 2 or 3 against you, and then you get stopped out before then the 15-minute chart kicks in, and then you go ahead and suffer a loss when you could have waited a few extra minutes for the 15-minute chart to kick in as well. So my preference has been, and probably will be for a long, long time to come, trading with those 15-minute charts far more than I do the 1-minute and the 5-minute charts. Todd?
Okay, great answer. Next question will be, what is the relevance, of the 3 and 5 simple moving averages?
Well, the relevance is that I use those as kind of speed lines in the market. And what we're talking about here is I look for those to go ahead and break below the 20-period moving average. And then if we're in a strong trend, generally what you'll see, let me get the highlighter up. When we're in a strong move, you see that they like to normally only pull back to the speed lines versus all the way back to the 20-period moving average. And if you go back and watch a lot of my YouTube videos, when you can just see right here and just on the chart I'm showing you, that's the case. So, I look for a break above the speed lines, the 3 and the 5 to get above the 20-period moving average, to break below it. So it's kind of showing me a trend. Here you see the 3 to 5 got right up to the 20 period, went ahead and pulled back, and then as we're making this bottoming pattern, it went ahead and finally broke out, more convincingly. The speed lines for me, though, the way I use them, if we're in a strong trend, I don't foresee us pulling back to the 20-period moving average, because like here, you broke out to the upside. If you waited for it to pull back to the 20-period moving average, you never got to go ahead and take a trade. If you started scaling in here with the 200, where the 200-period moving average was, and the rising speed lines, you are more likely to at least get a scalp out of that trade. And that's what I do. I use them in a rapidly moving market as the support and resistance levels of choice versus waiting for it to pull all the way back to the 20-period moving average. Todd?
Okay. Our next question is signs to say as price action reaches a support and resistance level. Signs to say. I really don't know how to answer that question. But a lot of people asked it. Signs to say in as price reaches a support and resistance level. Oh, thank you. Thank you, Joe. So, I'm sorry. I have it in smaller print so I can have everything on my screen. It's signs. What signs do you look for to stay in as price reaches a support and resistance level? Thank you, Joe.
Gotcha. So this was operator error, huh, Todd? Is it Todd? Nice. Okay. Well, signs to say, well, first of all, as part of a sound strategy, you know what you have to look at here is a couple of things. Let me get my highlighter back up. If you're taking a long position, let's say down in this area here, you see there's a support level, or excuse me, a resistance level here, and then you see the next one is here, and the next one is here. I've taught in my YouTube videos about, you know, taking profit off the table, because if you look at this, let's say you took a trade right here, okay? Not that this is a solid 2-bar setup by any means. I just use this as an example. You took a trade right here, and you hit the resistance level. What happens if you go ahead and you hold the entire position into this area, and then you go ahead, if you get out of the position entirely because you hit the resistance level, well, you've made a profit of a couple of points. Otherwise, the other risk you have is you get up to here with all your position, you don't take any of it off the table, and it moves against you. And here, remember, you entered here, and now you find that you're 2.5 points against you down below. Next thing you know, you're like, oh no, I just turned a winner into a loser. I'm going to get out of this. You lose money, and the thing turns back around and goes back in the other direction. I would submit to you that it would be a more sound strategy then when you hit the resistance level. It's a known resistance level. For anybody that's been around my videos for 8 months or more, you know how well my support and resistance levels work. So one thing that you could say to yourself is, okay, I don't know if this is going to keep going in my direction, but I do know this is an important resistance level. So what I'm going to do is I'm going to take 25 or 50% of my profits off the table. I see that the 20 period is rising. I see that the 50 period is starting to turn around, but I don't know for sure what's going to happen because none of us do without a crystal ball. So what happens is you could, to be more sound, is since you don't know if a resistance level is going to be the final hold. Now, I would say this, if you go ahead and if this happens to be resistance level 2 on the day, on the pivot points, combined with one of my resistance levels, you're far more likely to go ahead and hold that level. In fact, I would submit to you, remember I just showed you yesterday, this was resistance level 2 on the daily chart, okay? So let's just give a live example of what I'm talking about. Let's move this over a little bit. Yeah, let's get this one. Okay, so here we are. This was resistance level 2 yesterday in the market, and it was right at my resistance level. Okay, so now you've got a whole lot of reasons between those two things to say, wow, we're at Robert's levels. We're at a resistance level 2. You know what? This is a far less likely reason to go ahead and continue to move forward. I'm just going to exit this whole trade. Okay. Now, if we're earlier in the day, so we're down in this area, and we go ahead and we get up to it, you've bought a pullback of a rising 20-period moving average here, and you get up here, you could say, okay, well, first of all, we got a whole day's trading ahead of us, plus we just bounced off the primary pivot of the day. That's what this was right here. Let me get my little highlighter on there. Okay, actually, you know what? Sorry. Get this one for you. Okay, so here's the primary pivot of the day. This is resistance level 2. So here you've got a rising 50-period moving average, a rising 20-period moving average. You got the resistance level here. If you went ahead and bought through a break of this level here, and you then, because you bought the pullback is what I'm saying, to the rising 20-period moving average, you know your first resistance level is right here. So a sound strategy is still taking off 25, 50% plus of uh, your trade right here for a profit, moving your stop up from down in this area up to break even, so that if this thing turns right back around and comes down, you get stopped out at break even here, but you've made a profit on the rest of this trade. If the market keeps going, though, because you're early enough in the day and you were only at the primary pivot, which was, again, showing how nicely it was holding as support, then you can let it run into the next level. And then you can say, you know what, now I'm at resistance level 1, which also, again, happens to tie with Robert's levels. I'm going to take the rest of my trade off here, or I'm going to take another 25% off. So now you took, let's say, 50% off at the first level here. You take another 25% off here and see if you can still get any more action. Or you just exit the rest of the trade right here and say, you know what, bears make money, bulls make money, pigs get slaughtered, don't be a pig. So, that's how I would play it. You'd never know if a resistance level is the final, end all of the day. But when you combine it with where my resistance levels are in this case, combined with where you're at in relation to resistance level 1 and resistance level 2 on the daily pivots, that will be a much better roadmap for you to determine how much you should take off, if not the entire position at that time. Okay? Todd?
Okay, great. Our next question is, when do you know when the trend has changed after a divergence, like a bullish or a bearish divergence?
Well, let's go ahead and clear off some screens here. Put things back to good. You recall on the chart here, one of the things I told you back, this goes back to my YouTube videos. I like to reference this because, a lot of people understand that I give a lot of great information in my YouTube videos, but not as many people as I think I'd like to have understand that. So I like to show how the things I teach in the YouTube videos still apply. And actually, here's exactly what you should be looking for, and that's why I still show this today on my YouTube videos. This is the Dow Daily chart. You notice I show this pretty much in every YouTube video. And one of the things I taught was, here was a bullish divergence, okay? That's where the arrows were. And then this was the downtrend, okay? So what should have happened here is, what happens with these divergences is you get these little humps, okay? So the price is going down, and then the humps are getting shallower. Okay, that's the positive divergence. So what should happen then is that you should break to the upside here. Okay, in this case, right about, in this area here, we should have broken and started trending up. Instead, what happened was the market started rolling back over. And this is a failed divergence. And why is this so important? Because a failed divergence is as strong of a signal as a divergence that actually works. So that's why I want to go ahead and share that with you. What you're looking for is that point where the divergence should go ahead and cross back positive. Instead, it fails and rolls back over. And that's why I kind of highlighted the point here. Let me clear the screen. You see on this bar, and I still have it marked to this day on there, how we went ahead and actually then started to roll back over. We should have been crossing positive here, and we actually had this down bar on the histogram. See that? A significant bar down. We should have gone ahead and actually, this should have been rising positive, and this whole price action should have gone ahead and been rising here. So that I'm trying to demonstrate two things here. How do you know it's working? Well, price would have started turning back up here, and the indicator, the histogram in this case, would have gone positive. How do you know it's failed? When you get your little lumps, in the shallow humps here, and instead of going ahead and going positive, it starts to roll back over again. Okay, so that's how we kind of know whether it's working or whether it's not working. Todd?
Okay, great. The next question is, when, if ever, does the cash market, SPX, I'm assuming he's referring to, seem to lead the futures? Does it make sense to try to follow this?
In my opinion, I do not believe you need to go ahead and watch the cash market as nearly as closely as the futures market. There's a host of reasons. I could probably talk about that for a couple hours. So in the interest of going ahead and keeping this succinct, um, my experience is, let me just put it this way. When I was a stock trader all through the 90s and driving myself batty every single night, looking at hundreds and hundreds of stocks, looking for just the right setup the next day, back in the day when I was actually crazy enough to still do that, before I got wise and realized, geez, I can just trade the same instruments every single day, like with the futures, and have the same things happen every day, and it's a beautiful thing, is that when I was a stock trader, I used the S&P futures as my guide to stocks getting ready to move. Okay, well, let's put this in English. Individual stocks go ahead and create the index. Then if the futures move quicker than the individual stocks, then by default they kind of move quicker than the individual index. I generally find, as a matter based on that fact, I generally find that the futures move quicker. It's one, instrument where a lot of concentration of cash can come into or out of very quickly, and so versus the S&P 500 cash index is 500 stocks. It's a basket. So versus the S&P futures, it's one instrument. I tend to find that they move a little bit faster in the futures. So no, I personally don't see a value of monitoring the cash in the middle of the trading day. As an overall analysis of the markets, I absolutely go ahead and find value, such as looking at the Dow Jones daily industrials, looking at the S&P monthly chart. For the long term, I certainly find value in looking at the actual cash indexes. In the short term, though, in intraday trading, and for that purposes and keying off a trade, even back when I was looking at the stocks, if I was trying to front run, if I was looking at, like Amgen and a couple of other stocks I used to trade, back in the day and stuff like that, I would look, for sell pressure or buy pressure to be coming into those futures as a lead off or a cue up for my stocks. Todd?